Okay, let's unpack this. Imagine you're an income investor, maybe nearing retirement or already there, and someone mentions an investment that offers potentially high yields and promises priority payments. The very name preferred stock sounds reassuring, like it gets special treatment, a step up from the ordinary. It feels like it should be safe, right?
Yeah, that name definitely suggests safety.
But safe compared to what? And what does that preferred status really mean when it comes to protecting your income and, well, your principal?
That initial impression is exactly what draws many income-focused investors in. High yields are hard to ignore, especially now, and the idea of getting paid before common shareholders feels like a solid layer of protection.
Right.
But as you point out, the critical question for this deep dive is peeling back the layers to understand the actual safety and complexity of U.S. preferred stock, particularly when you look closely at their credit ratings and how they're structured.
And that's exactly what we're going to do today. We're taking a stack of your sources, articles, research papers, analyses of this market, and diving deep into the world of U.S. preferred stock, our mission. To extract the most important nuggets of knowledge, cut through the potential misconceptions, and give you a clear picture of this asset class. Think of this as your shortcut to being well-informed about preferreds. So you can assess if and how they might fit into your investment strategy.
At its core, preferred stock is often described as a hybrid security. It possesses characteristics of both stocks and bonds, making it a unique creature in the financial landscape.
A hybrid beast, okay.
Yeah, that doesn't fit neatly into either box. And crucially, it sits in a very specific, sometimes misunderstood position within a company's capital structure, junior to corporate debt, but senior to common equity.
Right.
Understanding that positioning is foundational to everything else we'll discuss about its risks and rewards.
Right. So let's start by properly defining this hybrid beast. What is preferred stock technically, and where does it sit in that company hierarchy?
Well, legally, preferred stock is a class of equity. When you own preferred stock, you own a piece of the company, just like a common shareholder.
Okay, same ownership idea.
But the rights and claims associated with that ownership are different. The defining characteristic is that preferred shareholders have a higher claim than common stockholders, both when it comes to receiving dividends and, perhaps even more importantly, when it comes to the distribution of assets if the company were to be liquidated.
Okay, so if the worst happens and the company goes under, the preferred shareholders get paid out of whatever assets are left before the common shareholders see any money. That sounds like a significant advantage over common stock.
It is a significant advantage relative to common shareholders, but this is where the crucial point about capital structure comes in.
Ah, the catch.
While preferred is senior to common stock, it is generally subordinated to all forms of corporate debt. That means bondholders, the company's creditors, are ahead of both preferred and common shareholders in the liquidation line.
So everyone who lent the company money gets paid first.
Exactly. If there's not enough money to pay everyone, bondholders get fully or partially paid before preferred holders get anything. Then preferred holders get paid, if anything is left, before common holders. This priority order is fundamental to understanding the different risk levels of bonds, preferreds, and common stock from the same issuer.
So bondholders first, then preferred, then common. That hierarchical structure in distress is a key piece of the safety puzzle. What are some of the other defining features that make preferreds unique?
Well, the feature most attractive to income investors is undoubtedly the dividend structure. Preferred stocks typically pay fixed dividends. These payments are usually specified as a percentage of the stock's par value, often on an annual basis.
Fixed, okay, like a bond's coupon payment.
Similar idea, yes. But unlike common stock dividends, which can be raised, lowered, or suspended entirely at the company's discretion based on earnings and board decisions.
Right, very discretionary.
Preferred shareholders are entitled to receive their fixed dividend before any dividends can be paid to common shareholders. This dividend priority is highlighted in your sources as a primary benefit for income seekers.
That fixed payment and the priority over common stock dividends definitely echo characteristics of debt, specifically bond interest payments.
They do, which is why the hybrid label is appropriate. However, unlike common shareholders, preferred shareholders usually have no or very limited voting rights in matters of corporate governance.
No say in how the company's run.
Pretty much. Common shareholders vote on electing the board of directors, approving mergers, and other significant corporate actions. Preferred shareholders typically trade away that voting power in exchange for that priority dividend and the higher claim in liquidation.
Okay.
It's a classic trade-off. Control and potential growth participation versus income stability and a higher claim in adverse scenarios.
And you mentioned par value. How does that work and why is it relevant?
Right, so preferred stocks are issued with a face value, commonly $25 for issues traded on major exchanges, or maybe $1,000 for some institutional issues traded over the counter.
Okay, $25 is pretty common for the ones individuals might see.
Exactly, and this par value is a figure used to calculate the fixed dividend payment. For example, if a preferred stock has a $25 par value and pays a 6% dividend rate, the annual dividend is 6% of $25 or $1.50 per share.
Got it.
Now, the par value is distinct from the market price, which, like any security, fluctuates based on supply and demand, interest rates, the issuer's credit quality, and other factors.
So it can trade above or below that $25 par.
Absolutely. And understanding the relationship between the market price and the par value is crucial because, as we'll discuss, many preferreds are callable by the issuer at or near par.
Okay. So that call feature links back to par. Makes sense. Summing up these core features, priority dividends, usually fixed, no voting rights, higher liquidation claim than common but lower than bonds, and a par value really reinforces that unique hybrid status. It's equity, but with some debt-like traits.
Exactly. It occupies that middle ground, aiming to provide income stability and a higher safety net than common stock without the full contractual obligation or seniority of traditional debt.
This leads us to the company's side of the equation. Why would a company choose to issue preferred stock? What's in it for them compared to just selling more common stock or issuing bonds?
Companies issue preferred stock for several strategic reasons. The most straightforward is capital raising. They need funds for expansion, major projects, acquisitions, or simply bolstering their balance sheet.
Okay, but they could do that by selling common stock too, right?
They could, but issuing common stock dilutes the voting power of existing common shareholders. Since preferred stock typically doesn't come with voting rights, it allows the company to raise equity capital without diluting the control of current shareholders, which can be very appealing to existing management or founding families.
So they get the money without giving away votes. That's a clear corporate benefit. How does it compare to issuing bonds from the company's perspective?
Here's a critical difference. Bond interest payments are tax deductible for the issuing company.
Right, an expense.
Preferred dividends, however, are paid from after-tax profits and are not tax deductible for the issuer.
Oh, okay, that's big.
It is. This fundamental tax difference usually makes issuing bonds a cheaper way for a company to raise funds than issuing preferred stock, particularly for financially strong companies that can easily access the bond market.
Makes sense.
This is why, as your sources point out, companies with strong credit are less likely to issue preferreds unless there are other specific strategic reasons. They'll usually opt for the cheaper debt financing.
That's a key insight. Preferreds are generally more expensive financing for the company than bonds. So what are those other strategic reasons? Why take the more expensive route?
Well, one significant reason is balance sheet management. Since preferred stock is classified as equity, issuing it raises capital without increasing the company's debt-to-equity ratio.
Okay, so it looks better on paper.
It can, yeah. This can be crucial for maintaining certain financial ratios, adhering to debt covenants, or improving their perceived credit profile, even if the preferred dividend payments function somewhat like debt service. They get the benefit of raising capital without the balance sheet optics of taking on more debt.
So it helps them raise money without looking more leveraged to lenders or rating agencies from a debt perspective.
Or rare.
Right. Another factor is flexibility in payments, at least compared to bonds, while bond interest is a contractual obligation that must be paid to avoid default.
The ultimate sin for a company. Right. Companies can suspend preferred dividend payments without triggering a formal default event on their debt. Now, there are consequences. They usually can't pay common dividends while preferred dividends are suspended, and for cumulative preferreds, the missed payments accrue. But it offers a degree of financial flexibility in tight times that is not available with bonds.
That flexibility for the company sounds like a direct risk for the investor, that their expected income stream could just stop.
Exactly, and we'll definitely dig into that risk.
Yeah.
But perhaps the most significant driver for preferred stock issuance in the U.S., highlighted extensively in your sources, is regulatory requirements.
Ah, the banks and insurance
You
companies.
got it. Banks and insurance companies are subject to strict capital adequacy rules, requiring them to maintain certain levels of capital relative to their assets. Certain types of preferred stocks, especially those structured as non-cumulative perpetual preferreds, qualify as regulatory capital, like Tier 1 capital for banks, particularly following reforms after the global financial crisis. This is the primary reason why the financial sector absolutely dominates the U.S. preferred stock market, accounting for roughly 75% of the total market size according to one source.
75%. That's a huge concentration. So, a lot of the supply of preferred stock isn't just general corporate finance, it's explicitly linked to banks needing to meet regulatory capital buffers.
Precisely. It's a tool for regulatory compliance as much as it is for raising capital. And yes, sometimes companies with weaker credit might find it easier to issue preferred stock than bonds, or use it as part of a complex financing package, although as mentioned, for stronger companies, debt is typically cheaper.
So the why for the company is a complex mix of non-dilutive equity financing, balance sheet engineering, regulatory mandates, and sometimes access to capital when debt is less feasible or more expensive. Now, we keep hinting that not all preferred stock is the same. This is crucial for investors. What are the key features that differentiate one preferred issue from another?
Understanding these variations is absolutely critical because they define the risk and return profile of any specific preferred stock you might consider. The most fundamental distinction is between cumulative and non-cumulative preferred stock.
Let's break that down. Cumulative versus non-cumulative. What's the difference?
With cumulative preferred stock, if the company fails to pay a scheduled dividend, those missed payments accumulate. They are not lost. The company must pay all accumulated, unpaid preferred dividends before it can pay any dividends to the common shareholders.
So if the company has a couple of tough years and misses dividends on a cumulative preferred, they essentially build up an IOU, an arrearage that they owe you before common shareholders get anything ever again.
That's right. They have a legal obligation to clear those accumulated preferred dividends first. Your sources mentioned the case of Ford Motor Company back in 2006.
Right.
They suspended dividend payments on their cumulative preferred stock during a difficult period. Once their financial situation improved, they had to pay all the missed preferred dividends from the period they were suspended before they could resume paying dividends on their common stock.
Wow.
This cumulative feature provides a stronger degree of income protection for the investor because missed payments are deferred, not canceled.
Okay, that's a powerful feature for the investor. Feels much safer. What about non-cumulative then?
Non-cumulative preferred stock is different and riskier from an income perspective. If the company misses a dividend payment on non-cumulative preferred, that payment is generally gone forever. Poof.
Gone, just like that.
Yep. The company has no obligation to make it up later. They can simply resume paying future preferred dividends when able, and then pay common dividends without having to settle any arrearages on the non-cumulative preferred.
So a missed non-cumulative dividend is effectively just lost income. Ouch. That seems like a critical difference, particularly if a company hits financial bumps.
It absolutely is, and it's a major factor rating agencies consider, as we'll get into. Non-cumulative preferreds are often seen in the banking sector because of how they qualify for that regulatory capital we mentioned.
Ah, okay. So the banks issue the riskier kind for regulatory reasons.
Often, yes. For an income investor, this distinction is paramount when evaluating risk.
Got it. Cumulative dividends accrue. Non-cumulative are typically lost. Huge difference. What other features should investors look out for?
Well, many preferred stocks are perpetual. This means they have no set maturity date, unlike bonds where the principal is returned on a specific date.
No end date, so you just hold it forever unless you sell.
Pretty much. With perpetual preferreds, investors typically recover their initial investment by selling their shares on the open market, relying on whatever the market price is at that time.
Okay, no set maturity, you just sell it. What about the company deciding to buy it back? You mentioned callable.
Right. That's where the callable feature comes in, and it's very common. A callable preferred stock gives the issuer the right, but not the obligation, to redeem the shares at a preset price, typically the par value plus any accrued and unpaid dividends after a certain date, known as the call date or call protection date.
Why would a company do this? To save money?
Usually, yeah. Just like calling a bond, companies typically call preferred stock when it becomes financially advantageous for them. The most common reason is falling interest rates.
Ah, refinancing.
Exactly. If prevailing market rates have dropped significantly since the preferred was issued, the company might be paying a dividend rate much higher than they would have to on a new preferred issue or different financing. By calling the existing high dividend preferreds, they can reissue new preferreds or debt at a lower cost, saving money.
Okay, good for them, but what about the investor?
Well, this call feature significantly impacts potential returns for the investor because it caps your potential upside near the call price. If you bought a callable preferred above par, say at $26, and it gets called at the $25 par value, you lose that dollar per share difference.
So the company gets to refinance at a lower rate, but you, the investor, have your higher yielding investment taken away right when it's arguably most attractive because its fixed rate looks good compared to current lower rates.
Precisely.
That asymmetry of limited upside capped by the call price, but full downside risk if the company struggles, is a major characteristic of callable preferreds.
It is. It's essentially the issuer having a free option to buy your shares back when they become valuable to them, not necessarily to you.
Feels a bit one-sided.
It can feel that way. Another feature is convertible preferred stock, which gives the holder the option to convert their preferred shares into a fixed number of the company's common shares, often after a specific date.
That sounds like a way to participate in the company's growth if the common stock does well. Maybe get some of that upside back.
Exactly. The value of a convertible preferred is influenced by both the fixed preferred dividend and the performance of the common stock. The conversion can be at the investor's option, or, in some cases, mandatory if certain conditions are met.
Interesting. Then you have participating preferreds. What's that?
Right, participating. These, in addition to their fixed dividend, may be entitled to receive additional dividends if the company performs particularly well or pays out a certain level of dividends to common shareholders. They get to participate in the excess profits, so to speak.
A little bonus dividend if things are booming. Nice. Though probably rare. What about how the dividend rate itself is set? Is it always fixed?
Most preferreds are fixed rate, meaning the dividend percentage is set at issuance and remains constant for the life of the preferred, unless it's called.
Okay, the standard.
However, there are also floating rate preferreds, where the dividend rate adjusts periodically based on a benchmark interest rate like SOFR, Secured Overnight Financing Rate, or the prime rate, plus some spread.
So the payment can go up or down.
Correct. And then there are fixed to floating rate preferreds. These start with a fixed dividend for an initial period, maybe 5 or 10 years, then switch to a floating rate afterwards.
Why do that?
Well, floating rate structures can make the security less sensitive to changes in market interest rates. When rates rise, the dividend adjusts upwards, which can help cushion the price drop that fixed-rate securities often experience.
Less interest rate risk, but you lose the guaranteed fixed income if rates fall. Another trade-off. Finally, you sometimes see designations like prior or preference preferred stock. What's that about? More layers.
Yes, this is another layer of complexity. A company can issue multiple series of preferred stock over time. These series might have different levels of seniority relative to each other within the preferred class.
Ah, so not all preferreds from the same company are equal?
Potentially not. For instance, prior preferred stock would have a higher claim on dividends and liquidation assets than preference preferred stock issued by the same company, even though both are senior to common stock. It's essential to read the prospectus.
The fine print.
Exactly. Read the prospectus to understand the specific ranking of a preferred issue if the company has multiple series outstanding.
Wow, that's a lot of variations. Cumulative, non-cumulative, perpetual, callable, convertible, participating, fixed to floating, different priorities. It really drives home that you have to look way beyond the name preferred stock and examine the specific terms.
Absolutely. The devil is truly in the details with preferreds. You can't just assume.
Okay, let's take a step back and clearly compare preferred stock to the two other major asset classes investors are familiar with, common stock and bonds. We've touched on some points, but let's formalize the comparison from the investor's perspective. First, preferred versus common stock.
Right. Looking at payouts, as we've said, preferred shareholders get fixed, priority dividends. Common shareholders only get discretionary dividends if declared by the board. After all, preferred dividends, including any accumulated cumulative ones, are fully satisfied.
So preferred offers more predictable and higher priority income, generally speaking.
Generally, yes. But common stock has that potential for significant capital gains if the company is successful.
That's the key trade-off, isn't it? Income versus growth potential.
It really is. Common stock's value is directly tied to the growth and profitability of the company, offering substantial upside potential through price appreciation. Preferred stock, especially callable preferreds, typically trades closer to its par value and has limited potential for significant capital appreciation. Its value driver is primarily the yield, not growth potential.
So investors buy common for growth and capital gains. They primarily buy preferred for income. That's the simplest way to put it.
That's a good summary, yeah.
And the voting rights are the obvious difference. Typically none for preferred, standard for common.
Correct. And in liquidation, preferred are ahead of common shareholders, but still the last in line among equity holders. Common shareholders are truly residual claimants. They only get paid if there's anything left after everyone else, including preferred shareholders, has been paid.
And in many bankruptcies,
There's nothing left for common shareholders. Often very little for preferreds too sometimes.
so the investor trades the high growth potential and voting rights of common stock for the relative income stability and higher liquidation preference of preferred stock.
That's the fundamental exchange when choosing preferred over common. You give up upside and control for income priority.
Now let's compare preferred stock to bonds. This is where the hybrid nature can be most confusing because they share features like ongoing payments and par value.
They do share those surface-level similarities. Both are often issued at a par value, $1,000 for many corporate bonds, $25 or $1,000 for preferreds, and both provide a stream of payments, bond interest, and preferred dividends.
But the payment obligation is fundamentally different. You highlighted this earlier as a critical distinction.
It is the most important distinction, I think. Bond interest payments are a contractual obligation of the company. Failure to make an interest payment on time is a formal event of default, triggering potential legal consequences, acceleration of principal repayment, and potentially bankruptcy proceedings.
Serious stuff.
Very serious. Preferred dividends, however, are not a contractual obligation in the same way. As we discussed, companies can suspend preferred dividend payments without triggering a default on their debt. While there are consequences, like being unable to pay common dividends, it's not the same legal trigger as missing a bond payment.
So bondholders have a stronger legal claim to the company's cash flow than preferred shareholders, period.
Absolutely.
Yeah.
And that feeds directly into the liquidation priority. Bondholders are creditors. They have a higher claim on the company's assets in bankruptcy than preferred shareholders who are equity holders.
Creditors before owners.
Exactly. Bondholders get paid before preferred shareholders. Also, most traditional bonds have a fixed maturity date when the principal is repaid, providing a return of capital at a specific time, whereas most preferreds are perpetual. No guaranteed return of principal date.
What about the tax angle we touched on? That seems significant for an income investor in the U.S.
Yeah, this is a major difference for U.S. investors and a potential plus for preferreds. Bond interest is typically taxed at ordinary income rates, which can be, up to 37% at the federal level, depending on your tax bracket.
The highest rates.
Right. Preferred dividends, however, often qualify for the qualified dividend income QDI tax rate. These rates are generally lower, 15% or 20% for most investors, sometimes even 0%, similar to long-term capital gains rates.
That's a big difference in the tax bite.
It really can be. This can make the after-tax yield on a preferred stock significantly more attractive than the after-tax yield on a bond with a similar pre-tax yield for many U.S. investors holding them in taxable accounts.
That tax advantage is a powerful incentive for individuals to consider preferreds, especially high-income earners.
It can indeed be a significant factor in comparing the net return of a preferred stock versus a bond from a similar issuer. Finally, reflecting their lower position in the capital structure and the discretionary nature of dividend payments, preferred stock credit ratings are almost always lower than the credit ratings of the same issuer's senior unsecured bonds.
Lower rating means higher perceived risk.
Exactly. This lower rating reflects the higher perceived risk from the rating agency's perspective, which is why preferreds typically offer higher pre-tax yields than the senior bonds of the same company. Investors require more yield to compensate for that extra risk.
So higher yield than the company's bonds, but also explicitly rated as riskier by the agencies. That brings us to the upsides. Given these comparisons and nuances, what are the actual benefits of investing in preferred stock, particularly for that income investor?
Well, the most compelling benefit, as we started with, is the attractive yields. Preferreds generally offer yields that are higher than those on investment-grade corporate bonds or dividend-paying common stocks from the same issuer or credit quality tier. For an investor focused on generating consistent income from their portfolio, that enhanced yield is a primary draw.
Can't argue with higher yield if you need income. And the dividend priority over common stock provides some comfort.
Yes, it offers a layer of security compared to just holding common stock. In times of financial stress, a company is legally obligated to prioritize preferred dividend payments over common dividends. For cumulative preferreds, this is even stronger, as missed payments must be made up. It means your income stream has a higher claim on the company's cash flow than the common shareholders.
There's some potential for capital appreciation, although limited compared to common. You mentioned that.
Correct. While not the main driver, preferred stock prices can appreciate. This often happens when overall interest rates fall, making their fifth dividend payments more attractive relative to new issues with lower rates, or if the underlying issuer's credit quality improves significantly. Your sources mention that asset managers sometimes look to realize capital gains this way. And that potential tax advantage for U.S. investors, the QDI treatment, is a big one for after-tax returns. Seems like a key benefit. It really is. For many individual investors in the U.S., the tax treatment of preferred dividends makes the effective after-tax yield significantly more competitive and often superior to the after-tax yield from taxable bond interest, especially from higher-yielding corporate bonds.
What about diversification? How do they fit into a broader portfolio? Do they dance to their own tune?
The sources highlight that preferreds can offer portfolio diversification benefits. Historically, they've shown relatively low correlations to both traditional stocks and bonds. One study cited showed a 0.36 correlation to long-term U.S. Treasuries and correlations of less than 0.65 to high-yield bonds and equities over a 15-year period.
Less than 0.65. That's pretty low compared to, say, stocks moving with stocks.
It is. This low correlation suggests that preferreds may not move in lockstep with your other stock and bond holdings during different market conditions, potentially helping to smooth out overall portfolio returns and reduce volatility.
Low correlation sounds like a good addition for managing overall portfolio risk. And speaking of volatility, are they less volatile than common stocks, or are they jumpy?
Historically, preferreds have shown lower volatility than common stocks. Comparing median rolling 36-month standard deviation over a 15-year period, one source noted they exhibited less price fluctuation than broad stock indices and even the common stock of the same issuers.
Okay, less jumpy than stocks.
And they were also slightly less volatile than credit-sensitive high-yield bonds over that period. So, they can potentially provide income with less price swing than pure equity, or even some riskier credit asset classes.
Less volatile than stocks and high-yield bonds, but potentially higher yielding than investment-grade bonds, especially after tax. That seems like an appealing combination for an income portfolio.
It can be, offering a potential sweet spot. And for those concerned about rising rates, the floating rate preferreds offer potential for lower rate sensitivity compared to fixed rate bonds or fixed rate preferreds. Their dividend adjusts upwards with rates, helping to cushion the price decline that fixed-rate securities often experience when rates climb.
That's a compelling list of potential benefits, especially for someone focused on income and portfolio construction. But we've also hinted heavily at the risks. What are the downsides and criticisms investors need to be acutely aware of? The other side of the coin.
Right. The most fundamental risk, distinguishing them from bonds, is dividend omission risk. Companies can suspend dividend payments without triggering a default.
The income just stops.
It can. While cumulative features mean you aren't losing the payments forever, you are losing the income stream when you expected it. Your sources note that studies have found a meaningful percentage of preferred issuers, around 6% over one 10-year period, deferred or canceled payments. This is a real possibility, not just a theoretical risk.
6% is not insignificant. So that income stream isn't guaranteed like bond interest. And in bankruptcy, you're behind bondholders.
Yes, that's subordination risk. As equity holders, preferred shareholders are junior to all bondholders, creditors, in liquidation. This significantly increases the risk of capital loss in a bankruptcy scenario compared to holding the company's bonds. While you are ahead of common stock, the amount available after bondholders are paid may be little or nothing.
And the call risk we discussed earlier, that asymmetry sounds like a major downside, like heads the company wins, tails you lose some upside.
It really is. Call risk is perhaps the most frustrating risk for investors. Most preferreds are callable by the issuer after a certain date, typically at par value. If interest rates fall or the issuer's credit quality improves, the company is incentivized to call the preferred stock to refinance at a lower cost.
Just when it starts looking really good for you.
Exactly.
Yeah.
This caps your potential upside near the call price and eliminates the possibility of benefiting from lower rates or improved credit through price appreciation beyond that call price. You have full downside exposure if the company struggles, but your upside is limited if it thrives and interest rates fall. Your investment can be taken away right when it looks most attractive.
It feels like the company gets to capture the upside from falling rates or improving credit, not the investor. What about price volatility? Are they immune to market swings? You said less volatile, but not zero volatile, right?
No, not at all. Despite often being less volatile than common stock, preferreds can still experience significant price volatility, especially during periods of market stress or economic recession. Your sources cite examples like price drops exceeding 25% for a preferred index during the 2008 financial crisis,
Wow, more than 25%.
and around 23% during the early 2020 COVID period. These are meaningful declines. They're not a substitute for cash or ultra-safe assets like treasuries.
Those are sharp drops, underlining that they carry market risk. And you mentioned their credit quality is generally lower than senior bonds, even from the same company.
Yes, that's another point of caution. While many preferreds are issued by investment-grade companies, the preferred stock itself is typically rated lower than the same company's senior unsecured bonds due to its structural subordination and dividend discretion.
So the issuer might be A-rated, but the preferred could be BBB or lower.
That's very common. One source reviewing a large preferred ETF noted that only a small percentage of its holdings were rated in the highest AAA or A+ tiers. A large portion were in the BBB, lowest investment grade, or even below investment grade categories, junk.
So you really need to look at the specific preferred stocks rating, not just the company's overall rating or its bond rating. And you mentioned some analysis suggesting historically lower risk-adjusted returns, like maybe not enough bang for the buck, risk-wise.
Yes, some studies presented in your sources indicate that over certain periods, preferreds have shown significant volatility relative to their returns, leading to lower Sharpe ratios compared to investment grade or even high-yield bonds. One analysis noted preferreds exhibited around 94% of the volatility of common stocks, but delivered lower returns than both investment grade and high-yield bonds over a 15-year span.
94% of stock volatility, that's high.
It is, and with lower returns in that study period. This suggests that for the level of risk, volatility taken, the return, hasn't always been superior compared to other asset classes over those specific timeframes. Of course, past performance isn't future performance, but it's data to consider.
That certainly challenges the idea that they're a perfect blend. It implies the volatility might be higher than you'd expect relative to the return.
And what about their performance in credit stress, like the '08 crisis?
A study covering the 2003-2011 period, which included the peak of the financial crisis, indicated that preferreds showed higher exposure to default risk compared to high-yield bonds during that specific volatile period.
Higher than high yield, really.
During that period, yes. This highlights their sensitivity to credit cycles, perhaps exacerbated by the heavy concentration in the financial sector, which was, at the epicenter of that crisis.
Right. The banks were issuing tons of these things, so they are susceptible to credit events, perhaps even more so than some high-yield bonds in certain environments. What about selling them? Are they easy to trade? Liquidity? Yeah. Liquidity can be a factor. While exchange-traded preferreds, $25 par, generally offer decent liquidity for retail investors, some institutionally focused issues, $1,000 par, often traded over the counter, can be less liquid. Meaning it might be harder or take longer to sell shares without impacting the price significantly, especially for larger positions or during market stress. The bid-ask spread might be wider.
And finally, with all these features and nuances, cumulative, non-cumulative, callable, different rate structures, different series, it sounds like analyzing an individual preferred stock issue is quite complex, not for the faint of heart.
It absolutely is. You can't just pick based on the yield and the company name. Understanding the specific terms outlined in the prospectus for that particular issue is crucial. Is it cumulative? When is it callable? And at what price? What is its specific ranking if the company has other preferred issues? What is the benchmark and spread for floating rate dividends? All these details significantly impact the actual risk and potential return profile for the investor.
That complexity is a good segue into how the experts, the credit rating agencies, assess these securities. Given the unique risks you've outlined, particularly the discretionary dividends and subordination, how do agencies like Moody's or S&P approach rating preferred stock? Do they capture all this stuff?
Well, preferred securities are, thankfully, typically rated by the major credit rating agencies. But, echoing what we've discussed, their ratings are generally lower than the ratings assigned to the same issuer's senior unsecured bonds. This notching down explicitly reflects their lower position in the capital structure and the unique risk of dividend omission.
So if a solid company has senior bonds rated A, their preferred stock might be rated BBB or even lower. That's standard practice.
Exactly. That's very typical. The rating reflects the specific risk profile of the preferred security itself, not just the overall health of the company as reflected in its senior bond rating. One of your sources gives us a really insightful look into how a major agency, specifically Moody's, grapples with these complexities. It's a request for comment proposal they issued back in 2006.
A proposal from '06.
Okay. Yeah, it's suggesting refinements to their preferred and hybrid security rating methodologies. It shows their thinking process.
Oh, tell me about that. What were they trying to capture in that proposal? What was the thinking?
They were proposing a more explicit way to incorporate the unique risks of these securities beyond just the standard notching based on loss given default, LGD, which is essentially how much you'd likely lose if the company defaults based on your position in the capital structure.
Okay, LGD is about loss after default.
Right. Their existing methodology already had standard notching rules based on LGD, but the proposal aimed to add a second step.
What was that second step focus on? Something different?
It focused explicitly on omission risk. This is the risk that a company could suspend or defer scheduled payments, the preferred dividends or hybrid coupons, without triggering a formal default on their debt. They proposed adding incremental notching, lowering the rating further, specifically to reflect this possibility.
So the rating would account for not just the potential loss if there's a debt default, but also the risk that the preferred payments might just stop, even if the company is still current on its bonds, that specific preferred risk.
Precisely. And this is where the distinction between cumulative and non-cumulative became absolutely central to their proposal. Under their proposed methodology, cumulative preferreds would not be subject to this incremental notching for omission risk.
I nod.
Because even if payments are missed, they accrue and must eventually be paid before common shareholders receive anything. The cumulative feature mitigates that specific type of payment cessation risk in their eyes. The obligation remains.
That makes sense. The obligation is still there, just deferred. So non-cumulative preferreds would be subject to this additional notching.
Yes, exactly. Because missed dividends on non-cumulative preferreds are generally lost forever, Moody's proposal suggested these securities would be subject to this incremental omission risk notching. Their modeling, as cited in your source, suggested that non-cumulative preferreds might be rated one notch lower than their LGD-based rating, specifically due to this non-recoverable omission risk.
That single notch difference, just based on whether the dividend is cumulative or not, really highlights how important that feature is to the perceived credit risk. It's not a minor detail.
It absolutely does.
Yeah.
It shows the rating agencies view the potential permanent loss of income on non-cumulative issues as a distinct and quantifiable risk. The proposal also extended this thinking to certain hybrid securities that have features allowing for payment deferral without default.
Right, those other funny structures.
Suggesting they would also be subject to this incremental notching if classified as having strong or moderate equity content in their no ongoing payments dimension.
So they were trying to capture that fuzzy area between traditional debt and equity where payments can be stopped without triggering a full default. Make the ratings reflect that nuance.
Yes, they were trying to bring more clarity and consistency to how they rated those instruments, and they even proposed that if a security was currently omitting payments, it should be rated at least 2 notches below its LGD-based rating.
2 notches lower if they've already stopped paying.
Right. Their logic was that if payments have already stopped, the likelihood of continued or future omissions is significantly higher. It's a demonstrated risk at that point.
That's a clear signal to investors. If the company has already stopped paying, consider the risk substantially elevated, even if it's a cumulative preferred where you might eventually get it back.
Right. Now, it's important to remember this was a proposal from 2006, and methodologies can evolve. Rating agencies refine things. But the value of this source is how it transparently lays out how a major rating agency thinks about the specific non-default related risks of preferred stock.
Yeah, the mindset.
Particularly the distinction between cumulative and non-cumulative features and the impact of potential or actual payment omission. It underscores that the preferred rating is a crucial data point. Going beyond just the company's bond rating, you need to look at that specific rating.
That historical look gives us great insight into the rating agency's perspective on these unique risks. So, who is typically investing in these securities? Is it mostly individual investors drawn by yield, like the ones we imagined at the start?
Well, while individual investors are certainly buyers, particularly through exchange-traded preferreds and funds, institutional buyers are often the primary purchasers, especially in the initial issuance market. Big money.
Why institutions? What's driving them? Is it just the yield?
The yield helps, but a major driver, particularly for corporate investors, is a significant tax advantage in the U.S., the dividend received deduction, or DRD.
DRD. Okay, what's that?
Corporations that receive preferred dividends can deduct a substantial portion of those dividends, often 50%, 65%, or even 100%, depending on their ownership stake in the issuing company, from their own corporate taxable income.
Whoa. So they barely pay tax on the income.
Exactly. This dramatically reduces their effective tax rate on preferred dividend income, making preferred significantly more attractive on an after-tax basis compared to receiving fully taxable bond interest. It's a huge tax break for corporations buying preferreds.
So the same QDI benefit individuals might get is even more powerful for corporate investors via the DRD. That explains why institutions are such big players, especially other companies.
Exactly. It makes the after-tax yield very compelling for a corporate treasury or other institutional investors managing cash. However, individual investors do participate, attracted by the yield, potential tax benefits, QDI, and diversification.
How do individuals usually get involved?
They typically access the market via more liquid exchange-traded $25 par preferred shares or through diversified vehicles like preferred stock mutual funds and ETFs.
Okay, funds and ETFs make sense for diversification, which brings us to how an individual investor might actually use preferreds in their portfolio. Where do they fit realistically?
Based on the benefits and risks we've discussed, preferreds can fit into a portfolio primarily for income generation, leveraging those relatively high yields. That's the main draw.
Right, yield focus.
They can also serve as a source of portfolio diversification due to their low correlations to traditional stocks and bonds, potentially smoothing the ride. And, depending on the type, like floating rate, they might offer some degree of protection against rising interest rates or help reduce overall portfolio volatility compared to a portfolio solely in common stocks.
So there are potential tools for enhancing income, diversifying risk, and maybe smoothing volatility. How should someone go about selecting which preferreds to invest in? That sounds tricky.
Selection strategy is paramount, especially given the risks we outlined. It's crucial to focus on issuers with strong credit ratings and stable financial health. Chasing the absolute highest yield without a deep understanding of the underlying company and the specific preferred issue's terms is a recipe for potential capital loss or dividend omission.
Don't just grab the highest yield number you see.
Definitely not. Your sources emphasize this. Don't reach for yield without considering the credit quality and specific features. Look at the company's balance sheet, its profitability, its debt levels.
So look for solid companies first, then examine the preferred terms very carefully. And for diversification or simpler access, funds.
Yes, mutual funds and ETFs offer a convenient way to get diversified exposure to the preferred stock market without having to analyze individual issues and worry about liquidity for specific, less traded preferreds. They provide instant diversification across many issuers and preferred types.
Any examples or things to look for in a fund?
Well, your sources mentioned the SPDR ICE Preferred Securities ETF, ticker PSK, as an example, noting its focus on investment-grade securities, exclusion of convertibles, to avoid tying performance too closely to common stock, and issuer concentration limits as ways such funds can manage risk within the preferred universe. Different funds have different strategies, so you need to check their objectives and holdings.
Okay, we've covered a tremendous amount of ground. We've defined preferred stock, explored why companies issue it, dissected its many variations, compared it in detail to common stock and bonds, weighed its benefits and risks, looked at how rating agencies assess it, and discussed who buys it and how it might fit into a portfolio. Let's circle back to that initial question that got us started. For an American income investor, is U.S. preferred stock truly safe? What's the verdict?
Okay, synthesizing everything we've learned from your sources, preferreds offer undeniable attractions for income investors. Potentially higher yields than investment-grade bonds, priority over common stock dividends, that potentially significant QDI tax advantage for U.S. individuals, and diversification benefits. These are powerful tools for constructing an income-focused portfolio.
But there's always a but, right? They come with significant caveats regarding safety, particularly when compared to traditional bonds.
Absolutely. The sources make it crystal clear that preferred stock is fundamentally not as safe as traditional corporate bonds from the same issuer. They are lower in the capital structure, meaning bondholders are paid first in liquidation. Big difference.
And the dividends aren't guaranteed.
Right. Preferred dividends are discretionary and can be omitted without triggering a debt default, exposing the investor to income loss or deferral. even if cumulative. And the common call feature caps upside potential and introduces uncertainty about the investment horizon and future yield potential if interest rates fall.
And the ratings reflect this.
Yes, the lower credit ratings assigned to preferreds compared to senior bonds from the same issuer directly reflect these higher risks. The agencies are telling you point blank, these are riskier than the bonds.
So the preferred status is a preference relative to common shareholders for dividends and liquidation, not a guarantee of safety comparable to debt or any kind of absolute safety. It's preferred equity, not preferred safety.
Precisely. That's a great way to put it. It's preferred equity, not preferred debt safety. The actual safety of a specific preferred stock for an income investor hinges entirely on a comprehensive understanding of its unique hybrid nature, the specific terms of that issue. Cumulative versus non-cumulative, callability, rate structure,
All those details we covered.
the underlying financial health and creditworthiness of the issuing company, and the specific credit rating assigned to that preferred issue, which factors in its structural position and dividend discretion.
It's not enough to just see the word preferred and a high yield number. You have to understand the fine print and the issuer's strength. The potential QDI tax benefit for U.S. investors is a significant plus versus bond interest, but it doesn't magically eliminate the higher credit and structural risks that distinguish preferreds from senior debt.
Not at all.
It requires carefully balancing that tax-enhanced yield against those distinct risks.
Exactly. It's a trade-off.
Yeah.
And an informed investor needs to understand exactly what risks they're taking on for that potentially higher after-tax yield. Is the extra yield enough compensation for the extra risk?
So the core message from this deep dive is clear. Preferred stocks can offer enticing income and unique benefits like potential tax advantages and diversification, but they are complex instruments with risks, dividend emission, subordination, call risk that are distinct from both common stocks and bonds. Their preferred status grants priority over common shareholders, but they sit below bondholders in the capital structure, and their dividends are not guaranteed like bond interest.
Understanding the nuances of each preferred issue, especially the cumulative feature, callability, and the issuer's financial strength, is absolutely critical. Relying solely on the issuer's senior debt rating or just looking at the yield isn't sufficient. The specific preferred rating and the detailed terms tell the real story about the risk you're taking.
Which leaves us with a final provocative thought for you, the listener, to consider as you look at your own investment goals and the sources you provided. Given the added layer of complexity compared to bonds and the specific risks like the possibility of your income stream being suspended or having your investment called away just when it's performing well, is the potentially higher yield offered by a preferred stock worth those trade-offs for your personal income needs and risk tolerance?
Yeah.
How does that balance look in the context of building your secure income stream for retirement?
Something to really weigh carefully as you navigate the options available for income vesting. It's not a simple yes or no answer.